providing that cheer in the market right now, are investors perhaps misinterpreting what he's saying? Yes, he could be tapering rate rises, but the pivot is not here yet.
I think you're absolutely right, because based on what he said and based on markets' reaction that we saw overnight, is that the markets were leaning towards another hawkish Powell speech, and that was kind of proven, wrong or inaccurate. And I think that, what Powell has mentioned is essentially a balance of the getting the inflation down, and also it takes time for these rate hikes to actually factor in and also work its way into lower inflation. And we've seen as well that he has also mentioned that rates are probably going to stay as long as high as possible, and the peak is actually higher than where it was previously. So I think markets may be way in advance in expecting a pivot.
So you're saying that the rally we're seeing right now is not sustainable going forward?
Well, I think it will have to be that the markets is second-guessing the Fed, while the Fed is looking at data. So we need to be approaching a level where markets are really looking at data and really analyzing that inflation's come off, unemployment rate will stabilize, and potentially, we're seeing the non-farm payrolls coming up this Friday. So we need to see some more softer data on the job front.
Markets now pricing in a peak rate of below 5%. Is that what your assumption is as well, or not?
Our base case is that inflation is going to stay quite elevated. It's coming off, but it will be staying quite elevated into 2023. And in that episode, we do think that the Fed terminal rate could be above 5%.
Okay, well, Christy, with that in mind, I mean, we're looking at 5.25% according to some people here, and even more than that. The yield on the 10-year, 3.6% at the moment. I mean, that's come off the yield quite a bit right now. But is there more juice to be had if you wait around, in your view, if you look at not just sovereign debt, but investment-grade debt in the U.S.?
Yes, so themes tend to provide opportunities, and we do see that the opportunities going into some of the themes going forward is recession and reopening and recoveries. So these three themes provide opportunities, and we do see the opportunities in the U.S. Treasury space, in the IG space. Now, even though we are entering, I think, the expectations of recessions remains high, and even though the companies could be entering a recessionary period next year, the risk of defaults of investment-grade companies are very low. And the strong balance sheets and the ability to actually withstand the economic shocks going forward will actually make the investment grade a good opportunity for investors looking for income.
Yeah, and then you look at what's the dividend yield, I think it's just under 2 on the S&P 500. Now, the thing is that you look also at PE ratios, which historically, it's not cheap, the S&P. I mean, China's cheap and Hong Kong very cheap still. But you're after GARP, and you're looking at growth at a reasonable price. Now, that's the holy grail in many ways. Where'd you find it?
Well, that is where active management is very critical going forward. And we need to differentiate between, I think if you look at U.S. Treasuries over global equities, then definitely the favor is in U.S. Treasuries. But even in the equity space, perhaps we should be looking at certain emerging economies where they are actually valuing technology. And as you mentioned, valuations are getting attractive in some of these companies. And there's strength in the balance sheets, there's strong cash flows, and also dividend attractiveness in some of these companies in emerging economies. So you need to really differentiate between the dispersion between the underperformers and the outperformers here. And when the dispersion is actually wide, the opportunities are even greater. And we're seeing that in the space of technology innovation. So regardless of, and especially if the reopening trade is going to happen, some of these valuations are actually getting quite attractive. Of course, there are risks. I think we're still seeing some of the multiples and earnings still being squeezed.
Valuation still very low in China. We've seen about $1.7 trillion, of inflows into Chinese stocks. I mean, do you see a potential opportunity here? What might you be getting into, in the next few weeks, months, perhaps?
Well, definitely the reopening trade that did not happen. And I think the expectations of the reopening trade that will be actually be forthcoming. I think we've seen some of this happening, although it is not going to be a straightforward path. So there are still, I think, strengths in some of the Chinese equity space. And China is the only, I would say, growing, recovering economy in 2023. Although it is recovering into a slower growth profile in 2024, but nevertheless, if the COVID management policy does take a more stable outlook, we do think that there are opportunities in the Chinese equity space, healthcare, education, for instance.